Welcome everyone to Office Hours for TradersPost on this April 26th, 2024 day. And it's Friday. I know I should feel like it's a special day. It's the end of the week, but Mike, I'm sure you're in the same boat as I am. It feels like the weekend is just more days to work, but on something else.
That's
That's
right.
what that's what life is like now. Um,
Usually.
I, and I like it. I mean, I'll spend a few minutes with my wife and kids, and then after that, I get back to work.
A few minutes. You're like, okay, you've had it. I've had enough of you.
Well, you can build strategies. You can build strategies when you're making breakfast for your children, right? That's not going to work.
That is true. That is a
Money has
very
to
good
come from
point.
somewhere. Today, and I almost feel it's a good life. You've made a good decision when you're eager to wake up on Saturday and like, hey, I get some extra bonus time in order to get things done.
Absolutely.
So you guys are watching Office Hours for Traders Post. This is where we come at you every Friday to answer your questions about how to use our platform, how to use Traders Post to become the best automated trader that you can be. And every once in a while, we like to speak about markets because, Mike and I were obsessed about it, and we're sure you're obsessed about it too. This week, we have a great crop of questions that we're going to go over. But first, I just want to start off with an announcement, just a little piece of housekeeping about the Webhook library for TradingView that was online for a few years and it went offline. We are planning on putting it back up this week. There is an issue with the way that the PineScript now deals with global variables, and so I know a couple of people brought that up within the Discord that it's not loading properly. So we're getting that fixed, and then we're going to put it out. And along the same lines, we're going to be putting out a test library that handles the JSON payload in slightly a different way, just to see what people like, to see if that might be more useful or conducive to some people's programming habits. So expect that next week, and on next Friday, we'll do a walkthrough of how the library works, just to give a little refresher to people who haven't used it for a while, or this might be their first time.
Yeah, and for clarity, I think it's probably worthwhile to point out that what this library does is it basically makes it easier to construct your order messages to go from TradingView over to TradersPost. So we use a format called JSON, and typically what you'd have to do if you were writing custom PineScript is parse out this crazy looking string with all the different rules for what you want to send over to TradersPost. But what this library does is it makes it to where you can very quickly and easily pass along your order parameters, and it'll construct that JSON string for you. So you don't have to worry about whether it's syntactically correct or formatted properly or any of that stuff. It should work every time.
That's right, exactly. All right. So first up, our first question for this week is let me put that up. Our first question of this week is: do multiple accounts at the same broker count as the same broker connection? I guess there's always a different flavor of these questions that come with people trying to understand how our pricing model works and what actually comes with it. And
Mhm.
so here, this is a question that came up recently. And yes, the multiple accounts require multiple broker connections.
Right.
So they don't all fall under one. So if you have three accounts, even if it's at the same broker, you do need an upgraded account in order to be able to connect to them.
Yeah, maybe another way we could define it is by saying a broker connection counts as one broker for your account, your account level. So if you're limited to three broker connections, if you will, then even if you have three accounts at TradeStation, then that would count as three broker connections. The one caveat to this is that if you connect a broker account, it can be paired with a paper trading account, and that paper trading account doesn't count against you. So, I could have three accounts at TradeStation, three different paper accounts, and it doesn't count as six. It counts as three, if that makes sense.
Excellent. All right, next up, Mike, this is a question I put in this week. How do you avoid being swayed by a narrative while running a strategy? Let me just a little backstory here. I've been running
Please.
the strategy. I'm developing the strategy to be able to automate it. Just getting the rules I want to set in place, and it was working perfectly. It was working fantastically. It was working in the a bull trend or in bearish trend and in the switches. And eh, I don't know what happened. my rule said to do one thing, but I'm looking at a YouTube channel and I'm looking on Twitter, and then people are making the case for the opposite of what my strategy would be doing. And then, as Lady Luck would have it, price starts moving in the other direction, and I panic, and I completely scrap the strategy and jump in with my manual trading, and then place the trade in the other direction. And 5 minutes later, it moves completely against me, and
Mm.
it's half the account value. I double back in. I was like, it's gonna turn or whatever it is. I just panicked, and next thing you know, I'm almost down to nothing in this account. With a caveat, it's a small account that I put in specifically because I know I'm going to go crazy, and so I don't mind blowing out that account. It's almost nothing to me. But what's not nothing to me is that it seems to be. It doesn't matter what amount I'm trading. It doesn't matter how well I'm doing beforehand. I can still be a victim of narrative. How do you avoid that?
Yeah. Um, well, I've heard this come up time and time again, and I've definitely been a victim to it as well. The Maybe the earliest account that I heard about this was when I first read Nicholas Darvis's book, How to Make $2 Million in the Stock Market, and it's a book that was written back in the 1950s or 60s. Nicholas Darvis was a dancer, and he basically was a swing trader, and he had developed his own system of constructing basically a trend following strategy using what he called Darvis boxes. And he talked a lot about the sentiment of markets. And one of his worst trading periods was when he decided to join a trading group in New York, and he would go into their office and trade from their desk. So he had better access to information, and he thought he'd have a better setup. But then he started listening to what some of the other traders were saying, and their sentiment was counterintuitive to his setup. And immediately he started losing money because it didn't follow the strategy that he'd spent a lot of time developing. And so his takeaway was, I'm shutting everyone out. I'm not listening to the news. I'm not listening to any of these traders. I'm going to go, work in isolation again. His best results came from when he would establish his entry, do his research on a particular company. They had to have decent earnings and so on and so forth. And then they had to, start to form the boxes that he was looking for. But then he would go on tour and go dance for, 3 or 6 months or whatever. And he would just get telegrams through like Federal Express or whoever would send him messages to give him price quote updates. And he would just kind of track the charts that way. But because he was so disconnected from the markets, it allowed his strategies to actually perform. And he wasn't victim to some of the sentiment that he would have heard if he was still in that trading room. So that was a big lesson for me. And personally, I do the same thing. I tend to not read any news until after the market has closed, or if there is any kind of sentiment, I would want to incorporate that into my strategy. So there's probably like two ways you could look at this. Either you completely ignore that information, try not to get on Twitter, resist the temptation to go look up like what do people think of MSoft right now, or Google right now, because that sentiment might just be more noise than anything and might run counterintuitive to the strategy that you've worked so hard on. Or you start to incorporate that sentiment into your strategy so that it actually serves as a signal, and then that becomes a good basis for your thesis. But that's at least the way I look at it. I tend to very much ignore the data until after the fact, until after the trade's already done, and it doesn't have a chance of eroding my confidence.
Well, this is the problem with trading crypto. There is no rest for the wicked.
That's a fair
What
point. Yeah, 24/7 market, right?
That's right. So
Yeah.
what I'm finding is that I find that because I know that my strategy isn't 100%, because no strategy is, then already inbuilt, I have the doubt. And then I hear a piece of information that, and this is what sends me off the cliff, that I was already doubting. Like I had already looked at that and I had like discounted it for something. Like I said, okay, no, that's not going to work. Like I'm going to ignore that for this strategy. And then when it comes up again in the context of a losing position, that's where I go. It's not that I go, I was right before. I don't know if you had this before. I was right before the first time I thought about that. I should change my mind. Um, I, I have no inoculation against it. I don't know what to do.
Well, I think this is a good case for automated trading, where the automated approach is going to ensure that it trades your plan and executes your plan accordingly, which means that it's going to accept that there might be a loss in there. The if you've already determined that you've got a 70% win rate or a 60% win rate, then it's expecting 4 out of 10 trades is going to lose, and we're prepared with the stop loss for that, and that's exactly how it'll execute. Um, I think that the other thing that I've probably learned along the way, especially, between a mix of discretionary and automated trading, when I'm in the charts myself, when the trade starts working in my direction, I try to zoom out of the chart. I try not to let price movement sway my decision, because the closer you are to price at lower time intervals, the more sensitive you're going to be to it, because of the way that the bars scale on your chart, right? If you're on a 15-second chart or a 1-minute chart, generally those bars take up a good portion of your screen, especially if you're really zoomed in. And if you're not zooming out to look at the bigger picture of the trend you're trying to follow, then you're probably susceptible to being a little too sensitive to price action. So you'll want to look at like ATR, or some sense of where volatility is actually showing up. Is there some kind of volume signal that's telling you that maybe this trade is about to turn against you? Because otherwise, what you could just be paying attention to is drift. There could just be, maybe somebody's taking profits at this point. Maybe it's just noise. Anything there's any number of variables that could make it look like it's about to reverse. But I definitely try not to be too sensitive to price action when I've constructed a trading strategy that works over, let's say a 5-minute chart, and the average time in those positions is an hour and a half. Well, if I'm 30 seconds into the trade, then I'm probably too close, too zoomed in on price, right?
I think that zoom out thing makes a lot of sense. When I'm driving and somebody cuts me off, or I know this is tangential, but someone cuts me off or something like that, and my initial reaction is to go into Fast and Furious mode in order to chase them down and make sure that they know how unhappy I am. I tell myself, "Oh, that person has a pregnant person at the back seat, and they have to get to the hospital as soon as possible in order to." So I try to like zoom out for as far as a uh, person is concerned, to give them forgiveness. For the chart, zooming out does the problem with zooming out on crypto is that it moves drastically. It can move 10% in the other direction, and still you're right in your thesis, but I would get stopped out before then, because I'm not going to sit there with a 10% drawdown. And so that's where I don't have I feel like I don't have the luxury of allowing the thing to play out, because if I am wrong, if I'm wrong there, even if in that 70%, if my strategy is correct, I might be totally wrong for everything that's going to happen after that, because my strategy was depending on it now being bullish, and it's not going to run the same way when it goes the other way. So I just always feel like there's no way to not second guess, triple guess, quadruple guess myself, and that if I just set it and forget it, I feel just as bad if I come back later and it failed than if I made it fail by stepping in. That's my problem. We've talked about this before, where my failure state, no matter how bad it is, feels better
Right.
than the not failure. So look,
Right.
that's
Because then you can actualize the outcome and actually start to deal with the emotions that come with it. But
that's right.
it I don't know, this is kind of a problem of like the illusion of being able to forecast what's going to happen. I think oftentimes, especially if we're really close and really zoomed in on a very tight time frame, we often get the sense that somehow we can predict what the next sequence of bars is, especially over a longer time period than we're currently looking at. If you're on the 1-minute chart and you see one single bar, one 30-second move, and you're expecting that your trade's going to last at least an hour or two, it seems unlikely that somehow you've predicted what the next 2 hours is going to give you inside of 30 seconds, right?
Okay, when you say it like that, I feel pretty stupid. You're right.
Don't feel stupid. Like this is very much the process, right?
Right. All right. Cool. All right, so let's move on to the next question. That was my little Tom therapy moment. I gotta always take advantage of Mike when I get him. He's very busy. Next up, the next question is: why is it not recommended to use strategies on Renko or Heikin Ashi non-standard charts, or any non-standard charts, just programmatically, you should know that when you're dealing with TradingView, I don't know exactly how the other platforms work, but with these non-standard charts, the price that you're seeing on the screen as the current price might not actually be what the price is on the OHLC charts, the real time price. And so I've seen for a number of years now, people go, "Oh, my signal fired," 4 minutes later. What's going on? Why is it not working properly? And it's because of this. It's because the number that you're seeing on the screen on the non-standard charts is not necessarily corresponding to the real time. Now, there is an option that TradingView did add recently to strategies, where you can check off a box and it will use the open, high, low, close values of the real time chart. But I think this is only for Heikin Ashi charts, so not for Renko, not for Kaji, not for all these other ones. And so it's much better to use a real time chart. And sometimes there are scripts out there that you can use that simulate the non-standard chart Renko bars, let's say, on a regular chart. So you get all the advantage of having the signal fire when you're expecting it to, and then also the advantage of the trend detection from these non-standard charts.
Yeah, I think that's good feedback. I think the other thing to add to that is that charts like the Heikin Ashi chart actually revise the historical figures after the fact. So as new data comes in, the older data starts to become revised, and it actually changes and repaints the chart accordingly. We have a repainting article that we published some time ago, and I just revised it recently to cover how Heikin Ashi is one of the repainting factors to consider when developing a strategy, because what data you're looking at now isn't necessarily the same data it was 15 bars ago or 30 bars ago. And because of that change, you're likely to get one signal right now, but a different signal in 5 minutes from now. And that of course is not going to make a very reliable systematic strategy. So one thing that I have heard some people use and do is to create a Heikin Ashi signal that is based on the price, and that gives them sort of a lagging indicator, and then they still trade based on the actual chart. So they put the Heikin Ashi candles in like another pane and use that as an input signal to the actual chart.
Right. Perfect. All right. So this next question, it's going to be pretty broad here. Mike, I'm going to hit this at you. I didn't talk to you about this before because I wanted to get your real life reaction here. So I have one of my clients is a trading group, and they always refer to this idea of the silver bullet strategy, that they just have to. What's necessary is to put their heads together, fine tune, and they're going to generate a strategy that's just gangbusters. That's going to beat the market. It's going to make them so much money. And I'm not going to ask you if you think there's any silver bullet strategies, because I know what your answer will be. My question is, if hypothetically there were a silver bullet trading strategy for retail, what would be the characteristics you'd be looking at, other than let's say the metrics of it? Like, are there any? Do you have any inkling in your back of your mind when you go, well, if there was like a silver bullet strategy, like a near perfect strategy, it might have these types of characteristics?
Yeah, okay, that's fair. And maybe there's a better way to answer that. I think in the retail space, I think we have a lot of limitations. We know that data is slower. We know that oftentimes, particularly when we place orders, somebody at the institutional level is exploiting that order, right? They're going to make money off of your order. That's where I think the silver bullet opportunity really is in true institutional grade high frequency trading, where they're profiting off of the bid ask spread or paying for order flow. That's obviously a tried and true approach that works over and over and over and over again. And obviously lots of money is being made in that industry. That's not something we have the ability to access because it's so high speed that we're way behind. It's like the difference between walking a mile and somebody running a 100-meter dash. Like you're way behind where the institutions are. So because we have to trade on sort of longer time frames in order to really profit from a trend or from a reversal of some kind, I think that broadly speaking, many of the strategies that can work fit into one of two categories. Either they're mean reverting, where price has pushed so far away from the average, from some moving average or VWAP or something like that, that you can start to look for signals for when it might be reversing and will eventually revert to the mean. Then the other category is trend following or momentum. And there's lots of signals that you can use in order to construct that. You're looking for a continuation of some kind. You're looking for bounces off of a moving average. You're looking for rate of change, things like that. I think that the silver bullet in all of this, though, is simplicity. If you over complicate your strategy, try to add way too many indicators, try to add too many inputs, or over optimize your strategy, constantly trying to tune and dial in the numbers until you get something you're looking for, you either will end up with an overfit strategy, or it's just so complex that it will never generate a signal for you. So like the number of trades that it produces is so small over the time frame that you're looking for that you would have been better off just buying and holding the asset. And I've seen a few of those come through where you'll see like a 2-year chart and there were 7 trades and it did okay. Like it was profitable in the sense that it had a high win rate and the risk reward was good, but it didn't actually outperform the benchmark. You would have been better off just buying and holding over that 2-year period, and you would have made twice as much money. So I think there's a lot to take into consideration. There's certainly nothing out there that I'm aware of, and I'm certainly no expert in this domain. But at least in my several 8 years of experience of doing this, the thing that I've learned is simplicity is key. Taking some basic input and testing against that in a longer period of time as you can, and making sure that there's enough trades coming through to make it worthwhile.
All right, so that was very reasonable, and I'm gonna throw something out here that's gonna sound real crazy because it sounds crazy to me. And that is, you can't get an edge. Retail traders, it's almost impossible to get an edge based on information. Like you're just giving your example over there. Institutions have access to things that we just don't have access to. But then I like to think to myself, if if astrology is true, then perhaps or effective, perhaps because I've heard trading being described as astrology for men, so I really love that sort of sort of idea. One thing's been going on. My wife is an astrologer, and I just poo-pooed it. I just would just humor her, and then she would do things like, "Hey, let me run the numbers or whatever the astrology charts for a particular crypto coin, a stock or whatever," and she was getting a success rate for bullish or bearishness that was beating mine. So I go, okay, so let's say that that's because let's say that that's because I'm a poor trader, and so obviously, she doesn't have the bias of being inside of it. So through randomness, she's going to have a better success rate. Then I overlay the chart of the moon phases. TradingView have you seen the moon phases indicator on
Yeah, they
and you
recently
match that
released
with you match that with Bitcoin, and Bitcoin rises into the new moon, falls to the full moon, and rises to the. So then you go, okay, if there's going to be any silver bullet strategy, it has to be dumb on the surface of it, like so silly on the surface of it that no one's ever paying attention to it whatsoever, and that might be the. So if I'm just saying, if I hypothetically had to think of something, it would have to be something that a premise that we all already have all discounted. In general, that's what I'd be looking for.
Yeah. I think it's also like just looking at the chart though, and seeing that there's like the visual correlation between the two kind of reminds me of have you seen the website that was put out a long time ago called Spurious Correlations? It's
No.
it's a site that tries to compare two different things together to give you a sense of like how they might be correlated. But of course, the whole point is that correlation is not causation, right? There could be two things that fall in line together, but not necessarily actually have anything to do with each other. So like, let's see, I'll share my screen and we'll kind of cover this as an example. So this one says, here's the number of movies that Ewan McGregor appeared in and the number of ophthalmic medical technicians in Connecticut. Like perfect correlation. And And it even shows you the Pearson's R correlation, right? 0.87, extremely strong correlation over a long period of time. Here's the popularity of the starter pack meme and automotive recall calls for issues with airbags. Um, there were things like number of movies that Kevin Bacon has been in, and number of people who died in swimming pools or something like that. So I think it's fair to like point out the best thing to do when you're considering the relationship between two different inputs is really just to see how that stands up over a back test over a long period of time. And of course, you'll want to run a walk forward test on new live data as much as possible before you put real capital in front of it.
So what if how would you feel if strategy was created over those spurious correlations or the zodiacal releases when Mercury goes into retrograde, and it did perform well? Like, how long would it have to perform well before you go, well, maybe I should be trading these strategies?
Uh, it's a tough one. I think the tough thing to accept is that you have some kind of bias about the input data, right? Like it's easy to poo-poo astrology data because I think we have an opinion about it. But from that same perspective, you said it earlier, people kind of shooed the idea of technical analysis in general, saying that it's astrology for men, which I think is hilarious. Um, and yet we still engage in this practice every single day. I've even taken professional courses on this subject, and it still is a worthwhile endeavor. So I would say maybe if it held up over enough period of time and it seemed to be a reliable input, why not? Maybe there's something else other than the astrology data that's playing a role. Maybe it's that enough people think it's true that influences market behavior, right? Just like any
The feedback
indicator that
mechanism.
is commonly used on in technical analysis, if it influences buying or selling behavior, you're going to see a signal come from that.
Oh my God, Mike, you're convincing me more and more that I should be paying attention to this. I'm gonna be doing for fun as a bonding experience, astrology course with my wife because she talks about it all the time. I'd like to be able to not roll my eyes, and I think when I do that, I'll make a set of indicators for it, right? And then we'll see. We'll put it up against the common strategies out there and see how it goes. All right. Uh, the last question here, which I guess I shouldn't put on the heels of what I just talked about. Someone was asking in Discord group, can I reach out to Tom to develop Pine Script indicators and strategies? Although I appreciate the sentiment, I am chock full of clients. I have the people that I deal with regularly, and so I don't generally take new contracts. But you can always go on Fiverr, Upwork, Google, Perplexity, and find people who are willing to help you out.
We do have a recommended list of PineScript developers on the TradersPost documentation as well.
That's great.
I think we put you on there, Tom. We might need to pull you back since it's like you've got way too much on your plate. So
Oh, am I on there? I thought I thought I wasn't. Okay.
I can't
Yeah,
remember.
definitely.
Yeah, we'll have to check again.
Yeah. I have to take down my profiles online. I get messages all the time, and I was like, "Oh, I'll just keep them up," but I just disappoint people constantly. Fine. All right. So so that's it for our questions for this week. For
We did
office
get a
hours.
couple in the comments. Just so
Oh,
you know.
yes. Sorry, I
Yeah,
didn't see that.
actually, it looks like your brother asked some good questions here.
With everyone creating strategies from Peter Hartman, aren't the good ones already known? Why not just grab one that works? Why make your own?
Yeah, I like this. So I think it depends on your risk profile, and your risk tolerance rather. There are, of course, a number of tried and true approaches to the market, and you could say, well, the easiest thing for me to do is just to go buy the S&P 500, a low cost ETF, and just call it a day, and I can get the average market returns over the next 20 years. But if your risk tolerance is a bit higher, like I know it is for myself and for Tom, you're looking to explore other asset classes. And in the realm of trading strategies, I know I mentioned this earlier, the vast majority of them are mean reverting or trend following, and they all kind of have the same risk profiles available to them. In many cases, people do just pull very popular strategies off the shelf and attempt to run them. We did an interview with Jay Patadia on TradersPost some weeks back, or months back, and Jay had applied the super trend indicator and strategy to some futures contracts, but he combined it with a couple of other filters to manage drawdowns, to manage risk a little bit, and he did quite well. He 3x'd his account in less than 9 months. I think that the reason you would want to modify it is because you think that there might be some other form of data or some way to filter the strategy in a way that helps um, uh, smooth out some of the drawdowns, improve the strategy a little bit. And I think that generally we enjoy the pursuit of just trying to optimize as much as possible. That said, there's no shame in just pulling something off the shelf, testing it, making sure it's working for you, and running it.
There's also a part for me that, and you let me know if you feel the same way. Sometimes I don't only just want to win; I want to win in a particular way. Like like in chess, I want to win with the Catalan Open. I want to win with the Italian, and so there's a sense to me that even if I don't beat the index, I like the idea that I could be in the game and make some profit, based on the way that I'm going about it. So, for example, not to promote a specific product over here, but this is a service years ago I used to sign up for called Kedem, and essentially it would have a you would get a weekly document of, let's say, when uh, when there was cluster buying from insiders, when there were buybacks from certain companies, when there were SPACs that were being announced, when there were CEOs that were retiring or being hired, and these are all things that you can then develop a strategy around, like these predictable events or this type of behavior, and which I always found to be pretty fascinating. And so for a number of years, like I went through, what was fun to me is to figure out how I wanted to win. Did I want to be in the commodity space and make the uranium bet? Did I want to be as a gold bug and deal with the preppers and people who buy into gold mining, or do I like the crypto space because of the massive leverage and the degenerates, which turned out to be what I actually like. But the the way of winning was so interesting to me because when I would make a 3x profit on a junior miner that I bought, um, it wasn't as fun as, let's say, buying Tesla, right? Trading Tesla, where every day people are like, "Why would you ever have a long strategy for Tesla? Tesla's a short and it's going on to zero," and I would make money on the long side, and I feel good that way. And so, there's all kinds of different, as many different reasons for people to develop strategies as there are people, and I, eh, taking that to the extreme, you wouldn't imagine, you wouldn't accept the idea that, oh, ultimately there was one strategy that everyone agreed was right and everyone was going to run it, because by default that would make that strategy no longer work. And so there are these dynamics within the markets that, as a strategy works, there are then people who can come in and take advantage of it to make it not work, because then they know that you're banking on that and they could play the other side. So it's this dynamic system.
Yeah, I think that maybe another thing to point out is like ultimately we're all looking for an edge of some kind, meaning that we are able to win more than we lose, and ultimately when we win, we make more than when we lose. And that relationship between the two, of course, is what we're looking for. And there's a few different ways to find that edge. You might have technical edge or like an infrastructural edge. Like I mentioned earlier with the institutions, they've got extremely fast machines, FPGA cards. They're like 5 feet from the exchanges and with fiber optic connections. They've got a speed advantage that many of us don't have. So they can execute high frequency trades and profit on that bid ask spread, or just pay for order flow and profit from that as well. That execution time is like less than 7 milliseconds. It's extremely fast. The other type of edge, two types that I think fit within our realm of retail trading, is around analytical edge. You basically have some advantage over how you analyze information. Maybe you're using machine learning to analyze the historical data. Maybe you just have a particular way of looking at the market that other people don't. And then the other type of edge is informational edge. You might have external data that other people don't have. Maybe you've got, a bunch of consumer data because you run a retail e-commerce consulting firm, for example, and you've aggregated an insane amount of data around retail patterns. And so that gives you an informational edge about which retailers might be posting better profits in the future. And you use that informational edge in order to decide on, Nordstrom or, some other like Shein or something like that, whatever's publicly traded. I'm just making up some companies. But the point is, many of us, I think, sometimes have an insight in the market that can be used in order to create something that's profitable that ultimately could do better than if you just traded that asset directly and held it for a long time.
That's right. All right. Well, Peter asked here, if your backtesting and paper trading works, how likely is your strategy to work in real life? This is a painful question. It's a
You think
painful
so?
question. Yeah, there's a higher likelihood that basically you want the setups to play out the way that you want them to be. I find sometimes the execution of the setups is where I have a problem, right? So my backtesting is showing essentially perfect setups, but then you get the slippage and all the misexecutions that happen on the live. But let's say all that works the way it's supposed to. Would you say, Mike, that okay, in that situation, if you're going to get a 3% return on your backtesting and forward testing, that's what you should be getting in real life?
I think that the method that's worked for me is more of the scientific method. So the process that I go through, and it sounds, a little dejecting at first, but really I think this is a worthwhile exercise. It's to start with the null hypothesis. It's the belief that I've done all this work to do the back testing and I've done walk forward testing, but I'm going to start from the premise that this strategy is most likely not going to work. Not that it's going to work or that there's some high degree of probability that it will, but rather that it's flat out not going to work. And so my work at that point, my objective at that point is to reject the null hypothesis, meaning that I'm looking for evidence that the strategy is actually working and rejecting the idea that it's not going to work at all. And I think if you start from that premise, you're less likely to be overconfident and over biased to the idea that somehow this strategy is worth putting in front of live capital. So the approach I tend to take is, this is a great thesis. I like the signal. Everything's looking good historically. I'm going to use my walk forward test to try to look for evidence that this is not working. And then if it still happens to be working, now I've increased my confidence, but I'm before I put live capital in front of it, I'm still going to, reduce my risk, start with a smaller size, test a few trades, let it run for a couple of weeks. And I'm still looking for evidence that, it's not working. And if the evidence is confounding against that null hypothesis, then I've successfully rejected the null hypothesis.
I'm finding a situation where the strategies that I develop are all short term in their duration, and so I mean to say that the strategies running on a thesis that I think only will be true, let's say, for 2 months,
I see.
and so I'm finding a situation where I'm not inclined to spend enough time testing out the idea, because then I go, well, even if it's right, I'm burning through the runway for where this can actually work. And so I just end up putting the automated strategy working live on the market with real capital right away, and I just tested with smaller amounts that I'm willing to lose. I mean, there's no real way around that. If my thesis is only good for 3 weeks, it's only good for 3 weeks. What are you going to do? But that process of then for me discovering new 3-week trade setups, that I find to be extremely rewarding
Mhm.
and provides me with sometimes really great upside, because it's not something that people have been sitting there and studying or observing for the last 6 months. Huh.
I think that's a great way to exploit the whole premise of it works until it doesn't. Your response might be, yeah, exactly. That's exactly what I'm looking for. The strategies that work until they don't.
Exactly. All right. John here does mention that Mike has a great goatee, which I agree. I agree. I thought it was Bizarro or Evil Mike coming, but he's just as nice as always.
Bizarro or Evil Mike. I'll take either one of those.
All right, so I want to end today with this idea here, because I've been really struggling with explaining to people. It's a good struggle, a fun struggle. There's they think of it as manual trading. They think of it as automated trading. Right? There's two camps here. That okay, I take my trades manually, and I set up a system that runs an algorithm for me. And it really clicked for me recently, this idea that no, your manual strategy is still an algorithmic strategy, right? I mean, if you're doing it well, if you're doing something that's going to work well over the long term, you're not just randomly throwing darts at the wall. You have set up a set of rules that you are then following, and the performance you're expecting to get is comes from the same sort of back testing and forward testing that we've been talking about. And as I've been seeing it in that way, it seems clear to me that any successful long-term manual trading is still automated trading. How do you feel about that idea?
Yeah, I think so. I started on a discretionary basis. It didn't take long for me to realize that I had this vast engineering background and a more quantitative background. I took stats, and I understood the machine learning approach, for me to want to develop quantitative approaches. But my first couple of years was a discretionary approach, and in that process, I tried to learn everything I could to become a successful day trader. Well, I guess uh, a crypto trader rather, because it was all in crypto during this time. But the stuff that I learned had more to do with psychology than anything. And of course, once you get past technical analysis, then the question is, how am I going to manage risk, and how am I going to manage myself? And because my psychology plays a huge role in my ability to produce profitable trades. It's the having to overcome loss aversion, loss chasing, revenge trading. Like, there's so many things to overcome, so many patterns that show up in everyone's behavior that you have to iron out in order to start seeing some improvement. And the when I think about it from that perspective, you realize what you're doing is trying to make yourself a machine. You're trying to make yourself the ability, the automated trading strategy that can be built by an actual machine. You're trying to eliminate some of those emotions. You're trying to trade consistently. You're trying to execute your plan exactly as you intended to. You're trying to listen to the signals properly, and so on and so forth. And so I think you're right. It's very difficult to distinguish between a human that trades like a machine and a machine that trades like a machine.
That's right. And if giving that, it actually, the more the more I think about it, the more it's actually silly not to use an automated trading platform, or not to be like familiar and intimately familiar with a platform that can actually help you. To me, it's like being a coder and just coding on the blank notepad and then put it into my system. No, I want a development environment. I want to use Visual Studio Code. I want an IDE. I want to use all these things that help me out. Or like I tell my son, you want to cut your own nail? Oh, you want to cut your own wood and make your own nails? You want to stand on the shoulders of giants in order to make sure that you're not making the same mistakes that were made before. And so using Traders Post to help turn your algorithm into an automated strategy that runs on its own, I think I think it's going to be inevitable that more and more people come to the conclusion that that's what you need to be doing. In fact, I think Mike is something that you told me when we first met, that you think that's where the and correct me if I'm wrong, but I think this is what you told me, that you think that's ultimately where the industry is going to go into, in the same way that technical analysis used to be in the domain of a few. Like, we talk about technical analysis now as if like, oh, that's just how people trade. It used to be that you have to go to some course, some class, uh, and to learn it. And people were mostly trading off of what they saw in the newspaper, what they saw in the news, what other people told them. You'd have to contact the company that you wanted to buy a share from in order for them to send you a share certificate. This technical analysis stuff that really exploded on the scene with the advent of tools like TradingView and what have you, has democratized access to TradingView, to technical analysis, to the regular people, but by no means was it standard. And the ability now to automate trades, to turn your steps, your strategies, your algorithm into an automated strategy, is something that, even though now is being done by a small percentage of retail traders, ultimately might be de rigueur.
Yeah, I completely agree. And of course, we have a good sense of research from the market here. We're constantly paying attention to how the retail landscape is changing, because this is the addressable market we're after as we grow our business. And there's no question that the algorithmic trading space is growing. What's interesting is it's sort of growing in two domains, though. On one hand, you have the institutions that engage in algorithmic trading, but not the same way that retail does. There's a big difference between the two. The vast majority of algorithmic trading that exists at the institution level is to help their clients execute huge block trades. If I'm, a large pension fund, for example, I want to buy a huge portion of Microsoft, let's say hundreds of millions of dollars worth. In order to do that, I want my trade to be VWAP guaranteed. So I use an algorithm in order to execute those trades, so that every time the price is near VWAP or there's an arrival price near VWAP, it'll automatically execute. They monitor, the books in order to find where they can sweep the books in order to execute a huge trade, and so on and so forth. Totally different domain. But on the retail side, I think the process of automated trading and developing signals and sending those signals through brokers is growing significantly. So we of course hope to help with that as much as possible.
I'm of the opinion that AI and crypto will cross together. And then, of the opinion, as if I came up with this, I saw a YouTube video that said that will cross together. And then what will happen is that we'll have all types of new types of asset classes that can be traded. And I think people will find out you can have automated, you can have automated, let me say that again. I think you could have automated strategies that work not only for the asset classes that we know, equities and crypto and bonds and all that, but for new types of things that'll pop up in this sort of like where knowledge becomes commodified within the AI world. And so I would not be surprised one day to. I'm waiting every day on Twitter. I'm waiting to see where AI hits into the retail trading space in the way that it surfaces new types of assets that could be traded, comic books, fan fiction, new deviant art, or whatever it is. I think new things will show up, and when people find out the technical analysis works there too, and you can develop strategies there too in order to figure out when you should buy that Rolex watch, when you should, when you want to figure out what city you want to live into or live in, or what job you should have, or what kids you should have. I wouldn't be surprised to see TradersPost all of a sudden explode with the types of things that can happen. But I'm idealistic. That's one day. Who knows?
I'm open to it. There is a growing domain of quants that have moved over to the sports betting realm, because there is a ton of data that can be analyzed there that is highly inefficient, and there's some real ways to exploit that. I have a couple of data scientist friends that started to move into that domain and have started a little fund around it. So there are some interesting emerging markets that not a lot of people have insights on. And that's, again, back to my point earlier, that's their analytical and informational edge.
You have Polymarket. I don't know if you've ever bet on Polymarket or anything like that, where you have the crypto space where you get to bet on events that occur, which is super interesting. And you can imagine if that becomes more easier to onboard and you get more volume, that technical analysis will play there as well, and where automated strategies work fantastically. Actually, I was saying that as if it's going to be some long dated thing. Ray Kurzweil has been right about the singularity thing, right? We're years away from these things happening.
Sure.
And I'm talking as if like I'm in the 90s again. We went from no one talking about video AI to now, video AI being like on the shelf. So, Tom,
Things
give
can
yourself
move
some more
fast.
credit.
Yeah,
Exactly.
things can move fast.
Yeah. Perfect. All right. So that should be it. It's fun, always fun to talk to you, Mike. It really makes Fridays something to look forward to. We're going to have more questions as always next week. So if you have anything you want to ask, please post it in the Discord chat, send us an email, or post it online on Twitter or any other platform. We'll find it. And we'll be happy to make sure that we keep making TradersPost the best automated trading platform for you and your trading needs. That's our goal. We're happy when you're happy, and we'll be successful when you're successful. And so let's work together in order to make this the dream come true. So I'll say goodbye to you, Mike, and we'll see everybody next week.
All right. Cheers. Thanks, Tom. Happy Friday.